The Balanced Scorecard stands as a transformative approach in the realm of strategic management, offering organizations a multidimensional framework for assessing and enhancing performance. Unlike traditional models that often prioritize financial metrics to the exclusion of other vital aspects, the Balanced Scorecard broadens the evaluative lens. It integrates financial outcomes with customer insights, internal process efficiencies, and the capacity for learning and growth, thereby providing a holistic view of organizational health. This comprehensive approach ensures that companies are not merely reacting to short-term financial fluctuations, but are also building the foundations for sustained long-term success. Originating from the pioneering work of Robert Kaplan and David Norton in the early 1990s, the Balanced Scorecard was conceived as a response to the limitations of conventional performance measurement systems. Kaplan and Norton recognized that an overemphasis on financial results could lead to the neglect of critical drivers of future performance. Their research revealed that many intangible assets, such as customer relationships, internal capabilities, and employee skills, were becoming increasingly important in the modern business landscape. Thus, they advocated for a more balanced and integrated approach, one that would allow organizations to align their daily operations with their overarching strategic objectives. At the heart of the Balanced Scorecard are its four perspectives: financial, customer, internal processes, and learning and growth. Each perspective offers a distinct vantage point from which to evaluate organizational performance, yet all are interconnected and mutually reinforcing. The financial perspective remains essential as it addresses the fundamental question of how the organization appears to its shareholders. Metrics such as revenue growth, profitability, cost management, and return on investment are central here, providing a clear indication of whether the company is achieving its economic objectives. However, financial outcomes are often lagging indicators. They reflect the results of actions taken in the past rather than illuminating the path forward. To complement the financial dimension, the customer perspective shifts the focus outward, examining how the organization is perceived by those it seeks to serve. In an era of heightened competition and rapidly evolving consumer expectations, customer satisfaction, loyalty, and retention have emerged as critical determinants of success. Metrics such as Net Promoter Score, NPS, market share, and customer acquisition or retention rates offer valuable insights into the company's ability to meet and exceed customer needs. By systematically tracking and responding to these indicators, organizations can build stronger relationships with their customers, differentiate themselves in the marketplace, and drive sustainable growth. The internal processes perspective delves into the operational core of the organization, scrutinizing the efficiency and effectiveness of the processes that deliver value to customers and stakeholders. This perspective prompts leaders to ask, what must we excel at internally to achieve our strategic objectives? Key performance indicators might include process cycle times, quality control measures, innovation rates, and the successful implementation of new technologies. By identifying and optimizing critical processes, organizations can reduce waste, enhance quality, and respond more nimbly to changes in the external environment. Equally important is the learning and growth perspective, which acknowledges that long-term success depends on the organization's ability to adapt, innovate, and continuously improve. This perspective emphasizes the development of human capital, the cultivation of a supportive organizational culture, and the effective management of knowledge and information. Metrics in this domain might encompass employee training and development programs, engagement scores, leadership pipeline strength, and the implementation of knowledge-sharing platforms. By investing in the growth and well-being of their people, organizations lay the groundwork for sustained innovation and resilience in the face of change. The true power of the Balanced Scorecard lies in its ability to translate vision and strategy into concrete, actionable objectives and measurable targets. Rather than existing as abstract aspirations, strategic goals are broken down into specific initiatives and performance indicators within each perspective. This process of cascading objectives ensures that every individual and team within the organization understands how their efforts contribute to the broader mission. It fosters alignment, accountability, and a shared sense of purpose, driving coordinated action toward the achievement of strategic priorities. Moreover, the Balanced Scorecard serves as a dynamic management system, not merely a static reporting tool. It enables organizations to monitor progress, identify emerging issues, and make informed adjustments in real time. Regular reviews of scorecard data facilitate a culture of continuous improvement, where successes are celebrated, lessons are learned, and corrective actions are swiftly implemented. This iterative process helps organizations remain agile and responsive in an ever-changing business landscape. One of the key advantages of the balanced scorecard is its adaptability across diverse industries and organizational contexts. Whether deployed in multinational corporations, government agencies, healthcare institutions, or nonprofit organizations, the framework can be tailored to reflect the unique goals and challenges of each entity. For example, a hospital might emphasize patient satisfaction, clinical outcomes, and staff training in its scorecard, while a manufacturing firm might focus on production efficiency, supply chain management, and product innovation. The flexibility of the balanced scorecard allows it to serve as a unifying language for performance management, fostering collaboration and alignment across functional and hierarchical boundaries. Implementing the balanced scorecard requires thoughtful planning and commitment from leadership. The process typically begins with the articulation of the organization's vision and strategy, followed by the identification of strategic objectives within each of the 4 perspectives. These objectives are then translated into specific measures, targets, and initiatives, creating a roadmap for execution. Communication and engagement are critical throughout this process, as employees at all levels must understand the rationale behind the scorecard and their role in achieving its objectives. Training, workshops, and ongoing dialogue can help build buy-in and ensure successful implementation. A common challenge in adopting the balanced scorecard is the selection of appropriate metrics. Organizations must strike a balance between comprehensiveness and focus, avoiding both the pitfalls of measurement overload and the risk of overlooking key drivers of performance. Measures should be relevant, actionable, and aligned with strategic priorities. They should provide timely feedback and support informed decision-making at all levels of the organization. Periodic review and refinement of metrics are essential to ensure continued relevance in a changing environment. The balanced scorecard also facilitates the integration of performance management with other critical business processes, such as budgeting, resource allocation, and risk management. By linking strategic objectives to financial planning and operational execution, organizations can ensure that resources are directed toward the most impactful initiatives. This alignment enhances organizational agility, enabling rapid responses to emerging opportunities and threats. Another significant benefit of the balanced scorecard is its capacity to drive cultural change. By embedding strategic objectives and performance measures into the fabric of daily operations, the scorecard encourages a shift from a narrow focus on short-term financial results to a broader, more balanced perspective. It promotes a culture of accountability, transparency, and continuous learning, where individuals and teams are empowered to take ownership of their performance and contribute to collective success. Over the years, numerous organizations have leveraged the balanced scorecard to achieve remarkable improvements in performance and competitiveness. For instance, companies like Mobil Oil, Hilton Hotels, and the U.S. Army have reported significant gains in operational efficiency, customer satisfaction, and financial results following the adoption of the scorecard. These success stories underscore the versatility and effectiveness of the framework across a wide range of settings. Despite its many advantages, the balanced scorecard is not without its challenges. Implementation can be complex and resource-intensive, requiring sustained leadership commitment and cross-functional collaboration. Resistance to change, lack of clarity in strategic objectives, and inadequate communication can undermine the effectiveness of the scorecard. To overcome these obstacles, organizations must invest in change management, foster open communication, and provide the necessary support and resources to drive successful adoption. In addition, the rapidly evolving business environment presents new challenges and opportunities for the balanced scorecard. Advances in technology, the rise of big data and analytics, and increasing stakeholder expectations are reshaping the way organizations measure and manage performance. The balanced scorecard must evolve to incorporate new data sources, leverage advanced analytics, and address emerging issues such as sustainability, social responsibility, and digital transformation. By remaining adaptable and forward-looking, the framework can continue to serve as a valuable tool for strategic management in the 21st century. The balanced scorecard's influence extends beyond the boundaries of individual organizations. It has inspired a broader movement toward integrated reporting and holistic performance management, influencing the development of frameworks such as the triple bottom line and environmental, social, and governance (ESG) metrics. These approaches recognize that financial performance, while essential, is only one dimension of organizational success. Long-term value creation requires attention to environmental stewardship, social impact, and ethical governance, all of which can be supported by the principles of the balanced scorecard. Furthermore, the balanced scorecard provides a foundation for organizational learning and adaptation. By systematically collecting and analyzing performance data across multiple dimensions, organizations can identify patterns, test hypotheses, and refine their strategies over time. This evidence-based approach supports informed decision-making and fosters a culture of experimentation and innovation. It enables organizations to anticipate and respond to changes in the external environment, seize new opportunities, and mitigate risks. In practical terms, the balanced scorecard can be implemented through a variety of tools and techniques. Many organizations use software platforms to automate data collection, reporting, and analysis, making it easier to track progress and identify trends. Visual dashboards and scorecard reports provide clear, accessible summaries of performance, enabling leaders to quickly assess the status of key initiatives and make data-driven decisions. In addition, regular strategy review meetings and performance dialogues help ensure that the scorecard remains a living document, guiding ongoing action and adaptation. The balanced scorecard also supports the development of a performance-oriented culture, where individuals and teams are motivated to set ambitious goals, monitor their progress, and celebrate achievements. By linking performance measures to rewards and recognition, organizations can reinforce desired behaviors and outcomes. This alignment of incentives with strategic objectives helps drive sustained engagement and commitment at all levels of the organization. From an academic perspective, the balanced scorecard has generated a substantial body of research and debate. Scholars have explored its theoretical foundations, examined its impact on organizational performance, and investigated the factors that influence successful implementation. While some studies have raised questions about the causal links between scorecard adoption and improved outcomes, the consensus remains that the framework provides valuable structure and discipline for strategic management. In recent years, the balanced scorecard has been adapted to address the unique challenges of different sectors and contexts. In the public sector, for example, the focus may shift from profitability to service delivery, citizen satisfaction, and social impact. Nonprofit organizations might emphasize mission fulfillment, donor engagement, and community outcomes. These adaptations demonstrate the flexibility and relevance of the balanced scorecard across a wide range of organizational forms and purposes. Looking ahead, the future of the balanced scorecard will likely be shaped by ongoing changes in the business environment. The increasing importance of intangible assets, the growing demand for transparency and accountability, and the accelerating pace of technological innovation all present new opportunities and challenges. To remain effective, the balanced scorecard must continue to evolve, incorporating new perspectives, leveraging advanced analytics, and supporting agile, adaptive strategies. In conclusion, the balanced scorecard represents a significant advancement in the field of performance management. By integrating financial and non-financial metrics across 4 key perspectives, it provides organizations with a comprehensive and balanced view of performance. It enables leaders to translate vision and strategy into actionable objectives, align daily operations with long-term goals, and drive continuous improvement. Through thoughtful implementation and ongoing adaptation, the balanced scorecard can help organizations achieve sustainable success in a dynamic and competitive world. Its enduring relevance and adaptability make it a cornerstone of modern strategic management, supporting organizations as they navigate the complexities of the 21st century business landscape. The balanced scorecard's multidimensional approach enables organizations to move beyond the limitations of traditional performance measurement. By considering financial results alongside customer satisfaction, internal process efficiency, and learning and growth, it fosters a more nuanced understanding of what drives success. This comprehensive perspective is especially valuable in today's complex and rapidly changing environment, where organizations must balance competing demands and pursue multiple objectives simultaneously. One of the distinguishing features of the balanced scorecard is its emphasis on cause and effect relationships among the four perspectives. The framework posits that improvements in learning and growth, such as enhanced employee skills and better access to information, enable more efficient and innovative internal processes. In turn, these process improvements lead to higher levels of customer satisfaction and loyalty, which ultimately drive superior financial performance. By mapping these relationships, organizations can develop a strategy map that visually depicts the pathways through which strategic objectives are achieved. This clarity helps leaders prioritize initiatives, allocate resources effectively, and monitor progress toward desired outcomes. The process of developing a balanced scorecard typically involves several key steps. First, the leadership team articulates the organization's vision and strategy, ensuring that these are clearly defined and understood. Next, strategic objectives are identified within each of the four perspectives, reflecting the unique priorities and challenges of the organization. For each objective, specific measures and targets are established, along with initiatives designed to drive improvement. These elements are then communicated throughout the organization, ensuring that everyone understands their role in achieving the scorecard's objectives. Effective communication is critical to the success of the balanced scorecard. Leaders must articulate the rationale behind the framework, highlight its benefits, and address any concerns or misconceptions. Engaging employees in the development and implementation process fosters a sense of ownership and commitment, increasing the likelihood of successful adoption. Regular updates on progress, coupled with opportunities for feedback and dialogue, help maintain momentum and ensure that the scorecard remains relevant and impactful. Another important aspect of the balanced scorecard is its role in facilitating strategic alignment. By cascading objectives and measures throughout the organization, the scorecard ensures that individual, team, and departmental goals are aligned with the overall strategy. This alignment helps prevent siloed thinking and encourages cross-functional collaboration as everyone works toward shared objectives. It also provides a basis for performance evaluation and reward, linking individual contributions to organizational success. The balanced scorecard is not a one-size-fits-all solution. Organizations must tailor the framework to their specific context, selecting measures and initiatives that reflect their unique goals, values, and operating environment. This customization requires careful consideration and ongoing review, as the relevance of certain measures may change over time. By remaining flexible and responsive, organizations can ensure that their scorecard continues to drive meaningful improvement. Technology plays an increasingly important role in the implementation and management of the balanced scorecard. Modern software solutions enable organizations to automate data collection, streamline reporting, and visualize performance trends. These tools make it easier to monitor progress, identify areas for improvement, and communicate results to stakeholders. They also support more sophisticated analysis, enabling organizations to explore the underlying drivers of performance and test the effectiveness of different strategies. The balanced scorecard also supports the integration of strategic management with other key business processes. For example, organizations can link scorecard objectives to budgeting and resource allocation, ensuring that investments are aligned with strategic priorities. Risk management can be incorporated by identifying potential threats to the achievement of scorecard objectives and developing mitigation plans. By integrating these processes, organizations create a more coherent and effective approach to strategy execution. One of the most powerful aspects of the balanced scorecard is its ability to drive organizational learning. By systematically tracking performance across multiple dimensions, organizations can identify what works, what doesn't, and why. This learning informs future decisions, enabling continuous improvement and adaptation. Over time, the organization becomes more agile, resilient, and capable of sustaining high performance in a dynamic environment. The balanced scorecard also encourages a focus on leading indicators, measures that predict future performance, rather than relying solely on lagging indicators, which reflect past results. For example, investments in employee training, a leading indicator, can lead to improvements in process efficiency and customer satisfaction, which eventually translate into better financial outcomes, lagging indicators. By monitoring leading indicators, organizations can take proactive steps to address emerging challenges and capitalize on new opportunities. In addition to its internal benefits, the balanced scorecard can enhance external communication and stakeholder engagement. By providing a clear and comprehensive picture of organizational performance, the scorecard helps build trust and credibility with investors, customers, regulators, and the broader community. It demonstrates the organization's commitment to transparency, accountability, and continuous improvement, strengthening its reputation and competitive position. The balanced scorecard's influence can be seen in the growing emphasis on integrated reporting and sustainability. Organizations are increasingly expected to report on a wide range of performance dimensions, including environmental impact, social responsibility, and governance practices. The principles of the balanced scorecard, comprehensive measurement, strategic alignment, and continuous improvement, are well suited to support these broader reporting requirements. By adopting a balanced approach, organizations can create long-term value for all stakeholders. Leadership plays a critical role in the successful implementation of the balanced scorecard. Senior leaders must champion the framework, model the desired behaviors, and provide the necessary resources and support. They must also foster a culture of openness, learning, and accountability, where employees feel empowered to contribute ideas, experiment with new approaches, and learn from setbacks. Effective leadership ensures that the scorecard is not just a set of metrics, but a living tool for driving strategic change. Change management is another important consideration. Implementing the balanced scorecard often requires significant shifts in mindset, behavior, and organizational processes. Resistance to change is natural, but it can be mitigated through clear communication, active engagement, and visible leadership support. Providing training, resources, and ongoing support helps employees build the skills and confidence needed to succeed in the new environment. Measurement and evaluation are central to the balanced scorecard. Organizations must regularly review their performance data, assess progress toward objectives, and identify areas for improvement. This process requires discipline and rigor, as well as a willingness to confront uncomfortable truths. By embracing a culture of honest self-assessment, organizations can accelerate learning and drive sustained improvement. The balanced scorecard is also a powerful tool for strategic renewal. As the business environment evolves, organizations must periodically revisit their vision, strategy, and scorecard objectives. This process of strategic review ensures that the organization remains focused on the most important priorities and is able to adapt to new challenges and opportunities. It also reinforces the importance of continuous learning and improvement as core organizational values. In summary, the balanced scorecard is a versatile and effective framework for measuring and managing organizational performance. Its multidimensional approach provides a comprehensive view of success, integrating financial and non-financial metrics across 4 key perspectives. By translating vision and strategy into actionable objectives, aligning daily operations with long-term goals, and fostering a culture of continuous improvement, the balanced scorecard helps organizations achieve sustainable success in a complex and competitive world. Its enduring relevance, adaptability, and impact make it an essential tool for leaders seeking to navigate the challenges of the 21st century business landscape.